Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the medium time frame bullish scenario, where we are looking at a corrective structure that is already finished and we are looking for new highs to come. In this particular scenario, this 3-wave corrective structure is a regular flat in a 3-wave A, 3-wave B, 5-wave C to the downside, where the most common target for wave C is between the 1 and the 1.236, taken from the high to the low of A to the high of B, and also wave C ended below the low of wave A, which is exactly what you want to see. Now the problem in this scenario, however, is this wave B, because wave B by itself is an expanding flat. And a flat structure in wave B in a bigger flat structure is, following the newest rules of Elliott Wave International, not allowed. Now I like to speak in probabilities, and it simply means the probabilities are low that you have a flat structure wave B in a bigger flat structure, which means that this scenario in general has lower probabilities. Lowering the probabilities, this is the low and new highs to come. Now if we do at least take this as the low and we look at the move to the upside, we want to see bullish structures to the upside. So let's zoom in to this structure over here and see if we can have some bullish structures to the upside. So there's 3 structures to look for. First of all, we have the regular impulsive structure 1, 2, 3, 4, 5. You don't want to see overlap between wave 1 and wave 4, but clearly over here we have overlap between this first move to the upside and this move to the downside over here, and then potentially 1, 2, 3, 4, 5. So that invalidates a regular impulsive structure, and therefore we have to think about diagonals or a double 1, 2. Now if we look at the diagonal, we're looking at this being a 1, 2, 3, 4, 5, but there's a bit of a problem here. So this wave 3 is longer in price than wave 1, as it tagged the 1 to 1 over here, taken from the low to the high of 1 to the low of 2. And a contracting diagonal is by far most common, where you look for structures like this, and each wave, wave 3 and wave 5, being shorter than the previous impulsive wave. An expanding diagonal is a lot more rare, so that's something that we never really look for, and the probabilities are always low for an expanding diagonal. So in this scenario, the fact that wave 3 is longer than wave 1 is kind of already invalidating a diagonal. However, we have another invalidation, which is the low of the channel over here, because for a contracting diagonal, you want to see price converging. You want to see price doing something like this, where the upper trend line of the channel and the lower red trend line over here, the red line, are converging to one another. And the lower trend line of a channel is the invalidation of this scenario, the channel taken from the high of 1 to the high of 3 to the low of 2, because the moment the channel is hit, you have to think about, again, an expanding diagonal. But as mentioned, an expanding diagonal is incredibly rare and therefore never preferred. So the fact that wave 3 is longer than 1 and price has now hit the lower edge of the trend line or the lower trend line of the channel really decreases the probabilities for a diagonal scenario. If we then go to the double 1, 2 scenario, then in this particular scenario, the higher degree count is the green count in a wave 1, 2, and then a 3, 4, 5, and a lower degree count is the blue count, which is a 1, 2, 3, 4, 5, and that is the sub-degree count of the green wave 3. But that also means that wave 2 and wave 1 in blue by far most commonly are shorter in time and price than the higher degree wave 1 and 2, because they're a lower degree Elliott wave count, for a reason of course. However, this second wave 1 is already longer in price than the first wave 1, which is not what you want to see. And also this second wave 2, as it now took the double bottom over here, it's now also longer in time than the higher degree wave 2, which really lowers the probabilities for a double 1, 2 scenario and a bigger wave 3 to the upside. Another thing to mention is that we did not have any bullish CVDs at the lows over here, which means there was no absorption, strong absorption going on of market shorts with big limit long orders, which also again lowers the probabilities that this is the low and we are looking for a lot more upside to come. Now, if we then go to the bearish scenario and we zoom out again, then in this scenario, we are looking for a 3-wave corrective structure where the lows over here at 24.7K are still going to be taken. Now Bybit already took this low over here with a very big wick to 23.6k, which also increases the probabilities that other charts will eventually follow and take this low as well at 24,750, but it also increases the probabilities that Bybit will eventually fill the wick to at least 23.6k, if not lower, because if I look at my support areas down here, we have the double bottom, but below the double bottom, the first area of interest really for me is 21.8 to 22.6k, and the target for a wave C, if this is the high of B and then a 5-3-5 wave structure, then currently the most common target for wave C is between the 1 and the 1.236 here, which is between 22k and 20.5k. which includes the target box as I just mentioned, but also this one between 20.2k and 20.6k. So in this particular scenario, we expect the probabilities to play out for the double bottom to be taken, which is like a magnet for price anyway, for charts to follow Bybit and take this low, for the Bybit wick to be taken, which also has high probabilities, and eventually for the bearish scenario to play out, because also here the bullish scenarios, as just mentioned, double 1, 2 or diagonal, is not looking good. Now that means that this move to the upside then has to be a three-wave structure, right? So in the bearish scenario, so if we zoom in, can we find a three-wave structure here? Now first of all, it already helps that the bullish scenarios locally have a low probability of playing out. A double 1, 2, well, doesn't look good. Second wave 1, second wave 2 are longer in time or price. And in a diagonal, wave 3 is longer than 1, and also wave 4 now touch the channel. So if we think about corrective structures, we have the ABC over here in a zigzag, a 535. Most common target between the 1 and the 1.236 has been hit. Could be the move towards the downside for lower prices to come. Or we get a WXY, where W is a flat, then we have a double zigzag in X, and then we have Y, which is a zigzag structure. So even if you get another move now to the upside after this being an ABC structure and you get another bounce to the upside, the higher probability is still bearish for a wave Y. WX zigzag in a wave Y. Resistance areas for Y over here are between 29.1, 29.4. That is a very, very important area of resistance. And just above the 1.618, we also have 29.7, 29.8. So if we get a bounce, even though we might get a bounce and take this high, probabilities are still higher to then return to the downside based on the probabilities of how this move to the upside here is playing out at the moment. Now, if we zoom in more locally, then the eventually, I suppose, more bullish scenario to at least have another low for Y is this scenario over here, where we then have a wave A, wave B, and then a wave C to the downside. Most common target again over here has been hit, and also we have the target box, which has now been hit as extra support, which is sitting between 26.8k and 27k. However, just below the low that price made, we do have the daily naked point of control and the daily, so I would like price to hit these levels instead of hovering just above. So at least another move to the downside to hit these levels is very probable to me. But we do have additional support. It is the area for a wave C. So in this particular scenario, if you are looking for another move to the upside for that potential wave Y and looking for 29.2, you want to see support in this area. Market structure changes, bullish RSI, stochastic, whatever you're using, order flow. CVD divergence is something that gives you trust for a move to the upside, because of course the bearish scenario in this more local structure is that we have a 1-2, potentially another 1-2 and a 3 to the downside. So then you do get a bounce for another wave 2 and a move down, or we are already looking for a bigger wave 3 to the downside. So the reaction we get over here is very, very important. And in this more bearish scenario, this second wave 1 over here compared to the first wave 1 is already 3 times longer in time than the first wave 1, which lowers the probabilities a bit. But the main cutoff for me is if this wave 1 moves further to the downside and hits the invalidation at 26,839 on my Coinbase chart, which is a 1-to-1 taken from the high to the low of 1 to the high of wave 2, because then this second wave 1 would also be longer in price than the first wave 1, and that's not what you want to see, increasing the probabilities of either a potential ABC if we get some support here, or you get continuation to the downside. And if price goes to the lower levels here, 26.2, well, I'll be looking for a bigger move to the downside eventually. Now, if we then look at the CVD divergences, we kind of had CVD divergences all over here. So after the high has been made, first of all, over here, we get a bounce to the upside, and then bearish CVD divergences, bearish CVD divergences. Over here, locally, more bearish CVD, more bearish CVD. So there's absorption of market longs going on. Yes, we did have bullish CVD divergences here as well, but more locally, and local CVD always has priority, more locally, we saw the bearish CVD building up with each bounce that price gave us, which increases probabilities for a move to the downside, which has now happened. The fact that the double bottom over here has been taken before this high just increases the probabilities by a lot that price is going to look for lower levels below 24K. Now, if we then look at the probabilities of the different scenarios, then on the medium time frame, so on the higher time frame here, basically, the bearish scenario has a higher probability of playing out in an ABC structure. On the low time frame, the bearish scenario also has a higher probability of playing out. So we have a corrective three-wave structure to the upside. It is supported by what we also count here for any bullish scenarios, double 1, 2, very unlikely diagonal. Well, you can only get an expanding diagonal now, which is very rare in general, so that is never preferred, and a regular impulsive structure doesn't work, while corrective structures do work nicely with this move towards the upside. And on the micro over here, more and more locally, we have to observe the bounce, because this is important. Do we get continuation? Well, then we can be looking for much lower prices. And if we get a bounce over here, it's either then an ABC for another move up for Y, 29.2K, or we have a 1, 2, 1, 2, and then a continuation to the downside. But the ABC has a bit more probabilities compared to a double 1, 2. Because this second wave 1 is so long in time compared to the first wave 1. So that's something to keep your eye on. Now, I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use. And for now, thanks for watching and subscribing, and see you at the next one. Bye bye.